Good morning, everybody. My name is Laura Merlini. I'm responsible for CAIA. CAIA is the Charter Alternative Investment Analyst Association. I'm responsible for the EMEA market. EMEA is Europe, Middle East, and Africa. It's an extreme pleasure for me to be here with you today. And I know we have some CAIA members in the room, and I embrace them all. I would like to start with the first presentation. The first presentation, it's by Dr. William Schlosser, and he will tell us why log price predictions define overall asset value for timber management organizations. Dr. William Schlosser is a forester working in private industry for 40 years. He joined the academia 20 years ago and has kept himself involved in a mix of private consulting, and he also teaches forestry and conducts research. He likes to be called Dr. Bill, so we'll take the liberty to call him Dr. Bill during the course of this presentation. And he will present an overview of the real price appreciation forecast tool, and it's applied to timberland commodities. He makes timber price predictions, spinning years with incredible accuracy. So the floor is yours, Dr. Bill.
Well, thank you very much for that introduction. I would play that over again just to get the compliments that you delivered to me. I really appreciate you taking the time and giving this lead into where we're going with this discussion. I'm going to give you about 15 minutes of this discussion around the real price appreciation forecast tool, kind of what it is and why I did it. But the bigger question is, how do we use this to make actionable data for how we manage our forest land resources? This is what I really set in to do, literally put it into paper and pen about 10 years ago. That was a part of the ending of the last Great Recession when things were looking really bad, especially in the timber industry where we all spend our time. It is to look at where those timber commodity prices went and what the recovery rate would be. Okay, that is kind of the big joke is getting new batteries for my crystal ball, being able to predict what I don't know is going to happen. So I put down to do that kind of a task, and it worked. I've got the ability to make predictions about where the commodity prices are going to be for a certain type of the commodity within our markets. And I'm going to talk a lot about that, but that got put into paper and print, I should say, with the Journal of Forest Policy and Economics earlier this year. The journal article was submitted, a great set of reviewers, and that is available right now. Whether you go to the Forest Policy and Economics Journal website and grab it there, or there should be a chat line announcement about a web link that you're going to see two things on there. One is this journal article to a website. It's my company website. And also there's a YouTube video link, which is this presentation pushed into about a 25-minute entire program. You can take a look at it. Don't do it during this presentation. We're going to be talking about where this is all going from here. So where I'm going to start you on now is to spin it around to talk about the different types of terminology we're going to use. And I've heard this one a lot at this conference already, and that is a stumpage timber sale. Okay, in this timber sale, at least in the markets where I'm going to give demonstration of in the United States, the stumpage timber sale is not selling your logs. Well, it is in a way, but you're selling the trees. And the buyer is buying the trees. They're going to merchandise them. They're going to decide what mill to sell it to, and they're going to move your timber off. They're responsible, in this country at least, with the reforestation, for their erosion control, for everything else for the commodity use. That is a different type of a flavor. Then compare that one to the delivered log market sale. This is where my focus is, because here we're looking at the commodities that we manufacture out of our trees. That is different sorts, different grades. The sort is a group of logs. In our case, our example today is the Douglas fir, West Coast. So Psittacea menziesii, variety menziesii. That is Western Washington, Western British Columbia, Western Oregon, and California. That is a highly valued commodity. It's well known. It's a unique and highly valued commodity in this marketplace. But out of that tree that you cut down, you're going to merchandise a 2-saw log, a 3-saw log, a 4-saw log, and pulp. All those things come together in that tree. Sometimes not all of them, but definitely you're going to make the determination which commodity is coming out. That is the focus of this approach. I'm stepping into the delivered log market sales. And then the other kind of spin around is two terminologies I love to use is the nominal price and the real price. Okay, well, what really am I trying to build you up to on that is to say the nominal price is that's my money on the barrel head. Hey, that's the money you just spent on that cup of coffee you drank. It is where you spend your money today. And that super important aspect is that that is a commodity, the commodity of the currency you're using. That currency changes from day to day. We call it inflation, and that is where real prices come into play. The real prices are the nominal prices put into the currency of the day you used it. And that is the big step we're going to take a spin around here to express all commodity values in real prices. And we've done this for years, and there was always like a real price date selected, sometimes 20 or 30 years ago, which has very little relative value to us today. So I express everything in the most current real terms I can, the value of today. Here is a little bit of a pick on where we get the real price conversion factors. In the United States, it's coming from the Bureau of Labor Statistics, the BLS. When they manage our systems, they're the ones that are responsible for calling out a recession. We can see the recession hit here in about 2001 to 2002. It was fairly minor, but at the time it was a big event to be concerned about. Well, then that gave way and it rebuilt the economy. We had the Great Depression. The Great Recession. Okay, it felt as much like the Depression as it could because not many of us were around in the 1930s when the big depression hit. But with the Great Recession, we had a huge resettling of all the commodities in the marketplace. Financial assets plummeted. Things reset in the end of 2009. We're going to focus a lot on that particular event. You can also see some other things that happened here, and you got to scratch your head to say, given these indicators, that 2013, 14, and 15, that looked a lot like a recession. There was all the indicators in place to call it that way. And right now we have a new recession being called right now, kinda. It's a different color shade because it isn't acting like a regular economic recession. We're calling it the COVID-19 recession, but golly, it really hit the United States starting at about February of this year, and it's looking like recovery is established. Is that a problem of the COVID recession and the whole economic slowdown? Or is it a disruption to an otherwise stable economy that was trying to grow and rebuild? We're going to keep our eye on that one to see what we say. Well, I'm going to show you these kind of complicated, confusing charts. And what you're literally looking at here is a nominal chart. That is the price on the barrel head every day that existed for the last 30 years. In this case, for Douglas Fir 2 sawmill, I'm showing nominal and real. I show the real price here as well, which puts it in the currency of the year 2020, 10th month, October. Okay, that is putting it into the terms of today. In other words, this particular commodity, Douglas Fir 2 sawmill, was selling at its peak back in 1994 over $1,150 a thousand board feet. That's a lot of money compared to what we're getting today, right around 700. Okay, there was a big disruption that happened there. This is the history of data that we want to look at and understand. How do we really transition it? As I get into this whole discussion, though, I'm going to put this into the context of saying, why do we do this? I need to match the price forecasting for the commodity with the biometrics of what makes it grow. That is understanding how the environment, how the soils, how the species are able to react and energize to put on that new tree growth. Then I got to match that biometric growth and what kind of commodity it can merchandise as into the price of that commodity. Make the projections through time. We just saw a bunch of presentations about insurance. We saw it about trying to give better predictions about 1 trillion trees. This is the way to get those forests growing through time. The biggest interchange on all of this is I want to look at this financial optimality of our forest land sites, not just of the tree or of the log, but of the entire forest land site, because we have 3 big players: land appraisers, we have investors, in the assets. And then we have the foresters. And when they do it right, all three values should be identical. They have to match in order to get everything set good. That is the idea of forest merchandising and using the biometrics with your financial forecasts. So with all that said, as we march through this analysis, this real price appreciation forecast tool is not regression analysis. Hey, we've seen a lot of that, right? Everybody puts a trend line on it and tries to find out what we did in the past. Regression analysis in this case is for time travelers. I want to be looking at what the future is, that crystal ball I make a joke out. So in this case, you match it up with a Markov chain of order random walk. That is the economic theory behind being able to do this price forecasting endeavor. So what I do, I'm looking at just the real prices for this Douglas fir 2 sawmill species. I'm gandering at that price trend, and I got to see two important big things. Here it's looking at the 2020 October values, but I'm going to grab two important pieces on this nominal price at the lower left-hand corner of the red arrow and the upper price. Okay, that was from a stabilized price to a price disruption event. In this case, we got to say, hey, what kind of an economic theory did that? What was the economic instability that caused these prices to peak? And I got to say, it wasn't the normal economic disability. It was spotted owls. Well, across Western Washington, they got it listed as a threatened and endangered species, and everybody thought all the timberlands are going to be locked up. We got to get out there, cut them, and put them into the mill now. We'll never get them again. Obviously, that was overreaction, but the marketplace was real. Okay, that was one event where I'm going to measure that real price appreciation between the bottom and the peak. And then we're also going to get this LNV. It's called longevity. I want to see how long it took to go from stability to the peak of that disruption. But I'm going to spin this around now and say, what happened during the Great Recession? Well, the same kind of thing hit. I've got a difference between the two and in time, and then the amount of drop, that RPA per year. Okay, this is a unique setup on this particular species that we had one appreciation event, a return to stability, and then a devaluation event. And we're in the phase right now of return to stability. This is the RPA forecast tool. Like I keep saying, it's not regression analysis, it's a mathematical formula with a little bit of theory pulled in. The PF is the price forecast. That's my crystal ball number. IP is the initial price. That was when it was at stability in real terms. Okay, then that RPA per year is what I showed you on those two red arrows, that I'm trying to get those feel for what are the numbers that are coming from this. It's the regulator on our motor, how things are going to track together. T is just going to be the number, sorry about that. The T is just going to be the number of the time from price stability to now. Okay, in this case, it's going to drive back to 2006 when we had price stability in this market of Western Washington that I'm using for the example. Up to now, well, we're going to look at that number. You see some other machinations there with T again and longevity number. Let's put some numbers to it. This is that 2006 to 2009 Great Recession event and how it disrupted the price of this commodity. How do we track it out for where the price is going now? Right now, that formulation, all those numbers, walking through piece by piece, you see it's projecting that today's price, December 2020, is going to be $676.13 a thousand. Well, we don't take anything to the cents. It's all out to usually dollars within five. But the price for October was released. It was $9 higher. I'm sorry, $9 lower. You got to be kidding me, right? We hit this 10 years ago. This price forecast, literally, I made it in 2010 when I released the first version of this forecast tool. Hit those numbers and are able to predict them out. You see the red lines dropping across this line to show you where those prices are, where they're going, and how they are going to settle. The settling, I'm sorry there. The settling is coming out on the end of these red lines. You see that it doesn't hit them perfectly. It just shows us that trend. Right now, you can look at this 2006 to 09 price devaluation event and its recovery. You're looking right now at the price that just came out in October. There's that little trip down on the line bar. I expect to hit equilibrium by 2025 to 2030. That equilibrium march is expecting another economic disruption to hit. And it could be the COVID, it could be a real economic devaluation event or appreciation event. This is tracking the markets. So with all that said, we put in some boundary markers on it as I wrap around to the conclusion through it to say that these trend lines are showing us the automated autoregressive analysis assessment telling us, hey, how accurate is it? Is it biased? Is it something that we can give some, validity to? Well, as you look at these two lines, the outer line in each set is a 90% prediction interval. That 90%, if I had 90% of my values within this range, I'd be told that I'm working totally efficiently. In this case, I have 100% landed within that range, not 90, but all of them. You go down to the 60% range, and there we're sitting right around, well, what is it, 60% of our measurements. And the 60% range, I have 85% of our measurements landing in there. That means it's not only unbiased, it's super efficient. This is the kind of forecast you want to grab. Combine this with your biometrics, and you have the ability to take this prediction all the way out to every layer you want to apply it to. I do this for my forests. I piece it in with everything that I'm measuring within it's called the Forest Resource Analysis System software. You see the marker on the right-hand side. We give free demonstration sites of this, but the total idea is it's the timing of your timber harvest events matched with not just your biometrics, but also with the market forecasts. We heard in the last hour about the reserve price indicator. That is exactly what I use this RPA forecast tool for. When the price is high, make them fly. When the price goes low, let them grow. With that, I see that I'm right up to the 15-minute marker, and I would like to say I stand down and thank you as I stand for questions.
Thank you,
Laura.
Thank you so much, Dr. Bill, for your super interesting presentations. We have a question from the audience, and how much timber commodity data are needed for people to gather if they want to apply this tool in other timber market areas?
Yeah, that's a great question, because that is one of the cumbersome parts of it, that for this timber market data, what I really want is the open market data that is in a competitive market. Okay, the competitive market means you have many buyers and many sellers, and the price is negotiated as a random walk. Okay, that is a bunch of mills buying the timber. They're competitive. They want that timber value, but you got to have a price report of that generally by the month. If I can get those by month, I can match those with the general Bureau of Labor Statistics data to do the real price appreciation gaps, right? Turn the nominal prices into real. A lot of different places will try to record those on a quarterly basis. You're only getting 4 measures a year, and that's leaving a lot left open. You want to close those loops as much as you can. Now, the folks who have it are the lumber mills. That has been a catalyst in a lot of these markets for me to say, lumber mill, I'll help you to get that reserve price indicator for when you want to flip it around as the buying and selling, when you want to go high, when you want to go low, when do you want to increase your volume bought. That becomes a real catalyst to kicking it up where there isn't another association or agency collecting those data and releasing them. Get that market data, record it every month. Maybe even a couple of times a month, but really track them out as a monthly basis of prices.
Thank you so much. I think we have a couple of minutes for another question. How do you link them? And this is, I think it refers to the last part of your presentation. And how do you link the market predictions with biometric forestland data? First part of the questions. And it seems that those arenas are not identical, as biometric measures annual growth, while your market predictions are made monthly. Yeah. So how are these pulled together? If you shed some clarity around this.
Well, I'll tell you, that was the impetus behind that Forest Resource Analysis System software. It's funny that the acronym for that is called FRAS, which if you're a forester, especially in the English-speaking countries, you know that FRAS is the word that is applied to the sawdust that comes out of the bark beetle's rear end. It is that little sawdust looking stuff. Well, anyway, with this FRAS approach, what I do there is match the biometric measures, which has annual growth. Now, when does the annual growth mature? Well, it hardens off around the middle of the summer. So really it's the release date of the biometric side, but the market data, we're tracking that monthly, because the more data points I get into that cloud, the more resolution I have for when I'm actually going to cut the trees. It's not that we're going to cut the trees every September 1st in the Northern Hemisphere because all the trees are hardened off and it's time to go. We're going to harvest all year round. We also know that we're going to harvest a tree that gives us a saw log and a pulp log in the same piece, but we have to match the price predictions with it. So tying those all together is what FRAS does. We bring in not just the biometrics that are put in obviously on an annual basis, and literally as I track them through on the biometric side, I give it annual projections for about 20 years. And then I go to every quinquennium, that is measuring it every 5 years, packing those out for 200 to 500 years into the future, depending on the biome you're in. That matching of time gives you a long spread to match with the price predictions you're making. Then, getting into a lot more of the weeds here, but literally, it's not using just the Faustman approach that we heard about in the last presentation, but the Faustman approach is the perpetuity optimization. But what we do is we take it as the current rotation optimal harvest date stacked with another rotation of a reforested parcel, and then the Faustman model after that. So that's 3 different rotations. The reason is that optimization for the interim stand, it gets tightened down depending on the landowner's discount rate. Man, that whole spin around gives you the ability to put a lot of meat behind financial optimization. I had to have the price predictions for the markets in order to make this entire thing come around. That's what the FRAS model does. I use it for land appraisals, for asset optimization, and for the forester to decide what is the financially optimal time to harvest. This gives the solution.
Thank you so much, Dr. Bale. I think your presentation has been as accurate as the data that you deliver. I'd like to invite all the attendees and those who came at the end, maybe of this presentation, to listen to the recording that will be made available by Carolina and Rafa. Again, Dr. Bill Schlosser explained why log prices predictions define overall asset value for timber management organizations. Thanks a lot for joining us today.
Thank you.